regarding the quantitative, and this is, this is the most difficult thing to, I mean, it, it's the most difficult thing to really judge and assess going forward. But the past performance, you have to remember when you're underwriting a new fund, you can't. You're not buying into the previous performance. You're not buying into those previous funds. You're buying into the go forward. Yes, there is going to be there may be some predictive value in those past investments, but you still have to develop a view of whether this team, whether this manager going forward is going to be really exceptional. And if you're only doing desktop analysis of a group's track record and not doing much else, then you're just going to be performance chasing and ultimately lagging behind peers that can assess other more valuable characteristics.
Superclusters is the podcast to demystify the secrets, stories, and tactics behind the money that moves the venture capital world. I am super excited to have Peter Teneriello on today's show. Peter has been an institutional investor for over a decade across multiple institutions, including Texas Municipal Retirement System, TMRS, for those who are spelling it out. And on top of that, he has been is a proud Kauffman Fellow, Class 24, and a graduate of the University of Notre Dame, and a member of the amazing Bengal Bouts team there. Something we'll get into really, really quickly. He's someone who's put on multiple hats across buyouts, growth equity, asset manager stakes, distressed credit, special situations, in quotes, and direct lending and real estate. I'll be honest, the last 7 of which is above my pay grade. But that's exactly why I love our conversations, Peter, because we'll touch on a little bit of this, a little bit of that. So, Peter, we're also really lucky to be able to measure our friendship over the magnitude of years now instead of months or weeks. And you've been instrumental to my own journey as an LP and welcoming me with open arms into the industry. And in many ways, in the process of reading and learning, I've been going over your writing for a lot of years, and it is frankly my rite of passage, or your writing was my rite of passage. So naturally, as you know, since day one of this podcast, I've wanted to have you on. And finally, we have you. So I'm going to go on a limb here, and this possibly could be the greatest hour of your career. This podcast recording may very well outshine any of your previous accomplishments. Just kidding. So no pressure. Again, kidding. Nevertheless, thank you and welcome.
Yeah, absolutely. It's great to be here. And yes, we're finally doing it.
We're finally doing it. It's been a long time in the making. So
yeah,
for our listeners, I want to provide some context to curry the favor of Peter, who's sitting on the other side of the microphone over here, and for him to bless us with his stage presence. So anyways, to maybe start us off somewhere, in the process of doing some internet sleuthing, if I might call it that, I did prefacing before this conversation, I came across a rather interesting nickname. I don't know the right pronunciation of this because I don't think I've ever heard it, but it's YE space YE, which I assume is yeah. I hope I'm not butchering the pronunciation, but could you share with our audience the significance and the origin of that nickname?
Yeah, so, well, it wasn't actually like a nickname. I know where you got it from. Yes, it was technically my nickname in my senior year, that I got to have for Notre Dame's boxing tournament, or for their annual boxing tournament. But yeah, it was a catchphrase, this phrase that my friends and I just started saying my senior year in college.
You should have trademarked that. You would have made a lot of money on it.
Should have. Look, there's a lot of things that we all wish we could have bought Bitcoin earlier. We all wish we could have bought all the right dips, and I should have trademarked that when there was still a chance, but alas, oh well.
Alas, hindsight bias. But that actually bleeds kind of well into my next question, because you've spent a lot of time in the boxing ring, and as for me, someone who's never stepped foot in a ring, not even watched one, well, not watched one live in person, could you share with our listeners the magic of having two fists up and having the never say dying fighting spirit for up to 12 rounds? And what about those years of experience in boxing that shaped you as an individual you are today?
Well, the fights that we had in Bengal bouts, which is what Notre Dame called their men's boxing club. The fights we had, they weren't full 12 round fights. To be fair, but I will say, but yes, like you are, again, it is just one on one. You are facing an opponent who, again, has been training for, training for maybe years at that point. And you're both. I mean, you're both going to get hit in the face. You're both going to get. You're both going to be hurting at the end of that fight, assuming you don't get hit. But again, everyone gets hit. I mean, I look back on that time, that experience, and to me, it was the most formative in college for me. I mean, the thing about the boxing ring, like, yes, like the way we did it, we all trained together as a team, but really, when you're in the ring, your success or your failure, it's entirely it's entirely on you, 100%. There's unlike a team sport where, yes, of course, like your effort matters, but say if you have an off day, maybe one of your teammates steps up and you end up winning, you end up succeeding. And in the boxing ring, if you have an off day, then you're going to get pummeled. It requires your full focus, this full sense of flow, in order to be successful.
Not to cause too much whiplash here, but I think we're going to have thematically a lot of everyone has a plan until they get punched in the face kind of thing throughout this episode. But you're someone who has taken full advantage of Notre Dame's kind of offering of courses, including one fiction writing class, which I find to be very fascinating altogether. For you, and speaking of plans and writing and all that, have you noticed any follies that fund managers commit when it comes to sharing their narrative with LPs?
I don't think it's a folly that most managers, most investors think they're making, or even know that they're making. Is something that really only an LP who's meeting with dozens and dozens of managers is going to see, and it's that a lot of pitches just look the same. Look, this isn't even like a venture specific mistake that managers are making. This is across like the investment spectrum. Again, as you enter a pitch meeting with a manager, it becomes pretty quick it's pretty easy to realize early on whether a pitch has been overly rehearsed, overly coached, overly touched by someone that has, again, like help like been involved in lots of pitches for lots of different funds.
Do you often find yourself in the trust and leaving the reins of the conversation flow to the manager in which you're talking to for the first time? Or do you find yourself in this metaphoric, like, punch in the mouth kind of concept from Mike Tyson? Do you find yourself asking a question or making a comment to kind of get them off the rehearsal track so you can better understand them as individuals and as investors?
Those aren't mutually exclusive. I'd
That's
say
true.
I'd say yes to both. I like to push play and then just see where a manager decides to take the rope that they're given. I want to see I want to see how that manager ends up taking the story, and whether, again, like, it ends up going down that more predictable path, or vice versa, whether on their own accord they end up they end up going someplace that's a lot more special and interesting.
To make this more tactical for our emerging LP audience, are there questions you like going to or asking, even if they're open-ended in nature? Are there questions that you personally enjoy?
I'll go through the roster of the people on their team, see if there's any that I know. I'll look in the manager's background to see if there's any common threads that we have, or in their portfolio or in the list of portfolio companies, to see if there's any that I know. To just to try to make it that, or just try to create the situation where the manager almost forgets that they're talking to a prospective investor. That the manager, like the managers, just start to treat it more like a conversation, that instead of us being on opposite sides of the table, in fact we're really we're really on the same side of the table, that we're working together on this. Actually, maybe if there's maybe if there is a tactical suggestion, in a meeting, maybe try not to, as best you can, try not to sit directly across from this manager with this divide of some oak conference room table. Like maybe sit on the side, so you're, yeah, okay, maybe it would be kind of weird to same side it, but make it like, just take like a corner of the table, and you end up closer to that person, and more, better able to, better able to treat it more like a conversation rather than this very official pitch.
I want to rewind our time back to the time when you were in the Texas Municipal Retirement System, TMRS. And you wrote on your Substack back in 2020, which I find to be fascinating, that the four of you were a four-person team at TMRS at the time. You were tasked to deploy $1 billion annually across private equity and venture capital. And this might be I realize now, more jarring of a whiplash of a turn, so to speak, but could you break down the mechanics of how you take such a gargantuan number, $1 billion, and build an annual strategy around that?
Like you mentioned, our private equity team at TMRS had four people. Private equity was a growing allocation for us. It was one that had recently been increased from a 5% target to a 10% target on what, again, like what was already this 30 plus billion dollar pension plan. The in figuring out that plan, the most important constraint, the most important and the most difficult one to work around, was the size of our team, the people, the capacity that we had to add new manager relationships, add new investments, and to grow the scale of our portfolio. For instance, I mean, I remember in that time frame, like, meeting all these interesting venture funds, but like, through the course of the conversation, or even beforehand, the being told, like, oh, there's like, we have capacity for, let's call it, like, we have $10 million of capacity, that you could take, and in a lot of cases, in funds that were, let's call it, like 150 million or below, we just had, I mean, it wasn't really, it didn't make sense to even have that conversation then. It was just like, it was just that I could not afford to write a $5 million check. I could not afford to write a $10 million check. Again, at a billion, to grow a portfolio 10% of the plan, to deploy $1 billion in new commitments. I mean, what, like, we're going to write $110 million checks? No, that would cause the whole, that would cause the whole system to collapse. I mean, we because of that, we had to create this, we had to create a strategy that four people could keep in orbit. And what we ended up doing was, targeting, like, starting with that team, that team size, that capacity. Again, having four people, we determined that we could make about, let's call it, around 10 commitments or so that year. The check sizes, the check sizes end up ranging from, let's call it, 50 million to, maybe, 100 and upwards, and in some cases.
In deploying that all in 1 year, so let's give or take 10 funds. To allocate into 10 funds, whether it's buyout or venture capital, actually, out of that, let's say 10 funds, what percent of that ended up like being more venture capital? What percent of that ended up being more private equity, buyout kind of thing? And then on top of that, second question to that is, how many like funds do you need to talk to in order to arrive at 10?
To arrive at 10, you really need to be talking to several hundred. It I mean I'll I'll call myself out for taking for taking too many manager meetings sometimes and almost feeling overloaded by or yes and by feeling like overloaded by the number of manager meetings that I'm taking. But I believe I believe this is a game of I believe that allocation backing managers it must be done from the bottom up. It must be done by understanding who's in market, who all who's investing, in each of these different or however many different sectors that there are. I try my best not to take a top down, overly macro view of what's going to happen in the world. I look like I'm just one person sitting at a desk here in Austin, Texas. I even if I think I do great work, I'm not there's no way I can be an expert about what's happening on the other side of the world. The only way to do that is to really it's to meet with the people that are there. It's to meet with the people that are in San Francisco, New York, and in these areas I can't be sitting at day in and day out. So yes, in order to get to those 10, uh, you do have to meet with several hundred managers each year.
Just out of curiosity, once again above my pay grade, for the world of LPs, if they were to allocate into like private equity, in that private equity bucket, is it typical that venture is about 20% of that private equity bucket?
It will depend on the size and the type of LP that you're talking to. Like for instance, the Norwegian pension fund, or that's I don't know what their AUM is right now, but I believe it's somewhere north of $1 trillion. Doing venture just doesn't it's just not going to make sense for them. It cannot will not move the needle. So for a group like that, it's going to be zero. For say on the other end of the spectrum, and an endowment like the Yales, the Notre Dames, the groups that really can afford to take that illiquidity and are still small enough to access interesting venture names. Like yes, like they can they can afford to have a higher percentage of their book be venture. That said, one thing that I really try, to relate to the point I was making earlier about trying to avoid making these top down high level macro proclamations with how I invest the portfolio. I really I really shied away from filling or from trying to fill up buckets. That is, I didn't want to just have my buyout bucket and my growth equity bucket and my venture bucket and say, okay, like let's we're going to do three in each, and we'll have one wild card, and we're going to fill up these buckets every year, because I mean that's an approach that just isn't really rooted in the reality of how these markets move, how these cycles turned. How these cycles turn.
I talk to I spend a lot of time with like LPs who allocate a big portion to VC, and a lot of it comes down to they'll invest in VC funds, but they don't want those VC funds to be allocating into the same underlying asset, in the sense that if you're investing in 10 funds, you probably don't want like 4 of those funds to be all invested into Stripe kind of thing. That increases the risk in case Stripe doesn't do well. And Stripe's a great company, don't get me wrong, right? But is there something similar when you're looking at the equivalence of buyouts versus venture versus early stage, in the sense that, do you have like, hey, in the underlying bucket of what the companies in which they're investing into, we don't want more than 10% consumer or 20% enterprise? Or do you have those things when you're making these decisions despite market movement?
Related to just like pushing back on the on the top down approach that that's easy for LPs to fall on. I mean, yes, like it's something that it's something that you'll keep in mind, about, again, underlying company exposure, underlying sector exposure, but, um, again, like if like it's very difficult to, it's very difficult to predict how any one sector is going to move. Like what like again, me sitting in my seat here in Austin is going to know is going to understand how, the hundreds of millions of people that are, that comprise, say, industrials or comprise information technology. Like I alone am going to know better than anyone else how those people are going to act and move. Like, no, like that's no, it's like that to me is hubris. But yeah, I mean, yes, like you do have to keep. I mean, it's something to keep an eye on. That problem you describe, though, of companies, or sorry, of fund managers investing in the same company, and just in the risk in a portfolio, growing just due to that oversized exposure. I mean, it's a bigger, it's going, like, that's going to be a bigger issue in venture when you have, when you have just, I mean, club deals being a very, I mean, just a very important, piece of the funding ecosystem. If you back managers, investors who you believe to be, like, again, these creative, these creative artists, who work, who demonstrate conviction in the work that they do. Yes, like, so, like, sometimes, like, yes, like they will intersect. I can think of a number of examples of groups I backed before who end up co-investing together, or yeah, and investing in the same companies together. You know, like on one hand, like, you don't want to, on one hand, consensus bets aren't going to be what separate one from the pack. But again, if creative investors are doing all the work that they're doing, and and they find their way to the same company, then that's, I mean, then so be it. What's not going to work is me the LP telling the manager, hey, look, I know, like, I know you have this company that you really like backing, and that's, that you really feel is going to be successful, but this manager over here, who you may not even know, they're already invested in it, and we'd like for you, because of that, to, to not, to not load up on this company that you believe in. That would just be like a gross overstep of, of the LP GP relationship to me.
I totally agree. Like if they've yet to make the decision and someone else has made the decision before them, it's hard to like tell, like, hey, you know what, can't make this decision, even though it's probably a great company. That would be overstepping those boundaries. But I'm curious, does that affect like re-upping decisions? In the sense that it just so happened in the previous fund, like let's say previous three funds in which you backed, by their own thesis, they happen to have at least two underlying portfolio companies that like overlap across all three of them. Does that help you in determining, should I re-up into these funds, because in some ways their networks overlap with each other, so we only need exposure through one or two funds instead of all three funds?
So yes, for me, when those re-up decisions come due, I'm going to do my best to back channel, to really triangulate, across, across those different funds, and the people involved, like, which of them was really, which of them was really, like, the most important, the most involved with this one company, assuming that underlying company is doing well,
Hmm.
of course. But again, like, if these underlying funds, like, if they are building, if each of them does have, like, a diversified portfolio, um then they're likely not overlapping on very many companies. If a fund is overlapping on a third or half or even more of the companies, and yes, that's where you really do have to wonder. Okay, we're getting like these are almost the exact same networks. Um, there's there's much less of a benefit to having both of these funds in the portfolio. Let's just concentrate and
And
consolidate.
so to make sure I'm understanding this right, and I'm going to repeat it back to you, and you tell me if
Yeah,
I understood it right, which is if you're investing in a fund that has a portfolio of 50 companies, and like let's say like you're investing in diversified portfolios, this is for the larger LP world, and out of those three funds with 50 companies each in their portfolio, and they happen to overlap on 2 to 3 investments, doesn't mean much, right? Like in the sense that it's overlap as a function of portfolio size. But if you invest in concentrated portfolios, 10 to 15 companies per fund portfolio, and 2 to 3 overlap across 3 funds, give or take, then that is more meaningful of a percentage of that fund size.
yeah,
And that causes you
yeah,
to relook at relationships.
correct.
Gotcha. Um, I want to talk about marks as well. We're going off schedule here. We're going completely off
All
schedule
good,
here.
all
Um,
good.
in the scene of where, or in the scenario of where you have funds investing in the same company, and you can't control that, right? Like sometimes it just happens. Um, when you look at marks for the same companies, how do you as an LP take those marks? Because they might all mark company A differently. One might be like, I'm holding it at cost. One of them might be like, hey, you know what? I'm taking on the current markup, which they might have gotten a 20x multiple on revenue. Another one's like, hey, you know what? We'll take a 30% markdown just because we don't think it's as valued as high as it should be. How do you understand those marks as an LP?
Similar to what I mentioned earlier, I mean, you have to triangulate across those different funds. To talk, to talk to each of them, talk to other investors to get a sense for whether to get a sense for which mark is going to be the most realistic. Again, I mean, I've been lucky to not have to deal with. I've been lucky to not have to deal with that issue all that often, because again, it starts. I mean, in these questions about valuation, or well, in these questions about valuations, you're straying far from where an LP strike zone really should be. That is it should be around. Like their core competencies are going to be around, again, manager selection and the work involved with that. If you're getting into if you're getting really deep into the weeds about about like what the proper mark of a company, of a portfolio company should be, then again, like that's where you start straying from from what a lot of LP skill sets are going to be. Because again, like underwriting a fund is different from it's very different from it's very different from underwriting a direct company.
That's
It's a
fair.
different motion.
Um, So I guess my question was less so of like how does an LP determine the mark? I think that is more so the GP's responsibility than the LP's responsibility. But in the case where you have multiple marks, like in the case that you have to talk to your own stakeholders, whether you're a family office reporting back to the family kind of thing, or you are a pension fund or a sovereign wealth fund reporting back to your taxpayers' dollars or the kind of LPs in which you have, like you need to put out some kind of percentage growth, whatever number by the end of the year, by when reports are expected, right? And do you kind of take each? The reason I ask the question is like, do you take each mark for its face value, like in what the GP told you, or do you do some back channeling and amalgamate on one number for underlying asset rather than different ones across all assets?
I mean, you'll have to I mean, in those cases, like yes, you'll have to back channel, but but barring some really extraordinary circumstance, you're mostly just, you're mostly just gonna take the GP's valuations on their face. and when I say an extraordinary circumstance, if the marks are just wildly different, materially different, then yes, that's where that's where you may have to take a different mark than than what was given.
To make this a little bit more concrete, let's say hypothetically for a seed stage company, if someone has a mark of 15 million, another has a 17 million, another has 18 million, that's not extraordinarily different. But if they're evaluating the same company and it's like one's at a 5 million valuation, one's at a 15, one's at a $50 million valuation, then that might leave some room for consolidation.
Yeah, that leaves a lot of room.
On that thread, are there quantitative things that LPs typically overweigh against the qualitative, that maybe they should watch out for, or in your experience or in your friend's experience, and vice versa? Are there qualitative things that often get underestimated that should have a bit more limelight shown on them?
Regarding the quantitative, and this is the most difficult thing to, I mean, it's the most difficult thing to to really judge and assess going forward. But the past performance, you have to remember when you're underwriting a new fund, you can't. I mean, you're not buying into the previous performance. You're not buying into those previous funds. You're buying into the go forward. Yes, there is going to be there may be some predictive value in those past investments, but you still have to develop a view of whether this team, whether this manager going forward is going to be really exceptional. Um, and if you're only doing desktop analysis of a group's track record and not doing much else, then you're just going to be performance chasing and ultimately lagging behind peers that can assess other other more valuable characteristics.
So on that note, are there valuable qualitative characteristics that you personally look at?
Not just like referencing both on sheet and off sheet, but again, like the personal interactions you have with the manager, with their team, the way they talk about certain investments, the tone they use in those conversations, whether 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 they're like overly prepared to talk away investments that didn't work out, or overly focused on trying to steer you to conversations about the massive winners in the portfolio. Again, it's being present and understanding, like in the middle, like in the middle of these meetings. Just again, the tone and just the flavor of conversation that you are actually having.
Gotcha. I do want to underscore like the value of on sheet and off sheet references, and if there is a way to like look for, if you have the network, for our audience to look at off sheet references, like deals that other co-investors have done that you have personally know, founders that you know, executives, operators that used to work with said fund manager, they're extraordinarily helpful in getting a better picture of the fund manager in which you're backing as well. um, Okay, I'm going to switch gears a little bit over here, and something that I know you and I were both really excited to talk about, happens to be in the world of, um, just like signal versus noise, and just people coming out from the woodworks. Um, One thing I'm really curious about is, I mean, 3.5 years ago, at least at the time of this recording in 2024, you once said like every special situations distressed credit type manager has come out of the woodwork, and coincidentally all fundraising now. This is their time in their sun, and they've been waiting for a decade. They come out of hibernation, and here we are. And so, effectively, I do find history repeating itself, in the venture capital world and the private equity world, where 2024 happens to be the year, and this might be more ephemeral content in nature, but that people are coming out of the woodworks. And how are you evaluating kind of the signal versus noise ratio?
So to jump back to when I wrote that, to spring, summer 2020. I mean, that distressed credit special situations type of window, it opened and shut in like 3 months, if that. It just the way things roared back, during the second half of 2020, and post COVID. Um, that yeah there just wasn't the distressed opportunity didn't materialize the way that the way that a lot of investors really thought it would. It would. um it's, I mean, maybe some that goes to maybe some that's just related to the fact that most LPs are, most LPs, including myself, fell into this trap of taking like too top down of a view and saying, oh, like this, again, this pandemic has happened, the world is irrevocably changed. Now is the time for distress. And in hindsight, yes, like it would, like maybe yeah, maybe we shouldn't have been so top down in how we made decisions there. But anyways, fast forward to today, um, to again like this new, well, to again, this new golden age of private credit, as I've heard, as I've seen some people throw about. I mean, a lot of the pitches that I fielded over the past year were, were related to private credit, were related to direct lending. Very much, strategies that were very much not venture, strategies that were very much not leverage buyouts. No, the strategies that could get you higher returns than ever before, just because of the way that interest rates moved. Um, one, I mean, you, I mean, you started this off by mentioning signal versus noise, and one issue I ran into in looking at a lot of these funds is that a lot of them just look and feel the same. There's just not there's just not that much differentiation among a lot of these private credit, and private credit's a really broad category. So to be clear, but yeah, but like a lot of these private credit funds, like a lot of them, like what they're doing, like it looks and feels very similar to what competitor X and Y and Z are doing. I mean, it raises the stakes a lot for I think for picking the right manager, for making sure that making sure that you find someone that really is a force of nature, that really is this artist with how they invest. Because when the cycle does turn, um, a lot, like if you piled into the consensus investment opportunity, then you're going to end up with the consensus investment returns.
Are there things, out of curiosity, that have you don't have to name any names, but anything that has stood out to you in the past year and some change, give or take, in terms of the private landscape, managers pitching to you, venture capital, and so on?
It's the volume of private credit related strategies that are, out of the woodwork, in vogue. It's the way that funds, I mean, let's, funds in the venture world, or the buyout worlds, have struggled with fundraising. Like there's, I mean, there's a number of funds that I remember were kicking off fundraises, or just about to start fundraising. Let's call it like late 21, early 22, and checking back in, seeing their progress. Like they're still in market fundraising. It's just been that brutal of a season, of that brutal of a multi-year season. For groups, I would say, like, are really high quality as well. Um, so that, I mean, that's something that's really stood out to me. I mean, therein, like that does create an opportunity for, for access, for being able to partner with groups that, for whatever reason, like an LP may not have been able to access before.
That is very fair. Well, Peter, we're in the back half here. So I mentioned that I was going to be the last hard, I can't speak anymore, last hard hitting question that I was going to send you. But I also wanted, like, part of this, the purpose of this podcast is also to paint the human behind the LP world as well. So I'd love to ask a couple questions, just like to highlight some of the cool things you've done in your life as well. Um, so, I'm curious, as someone who has once volunteered to get his hair cut in front of the entire college lecture, has there been a more harrowing experience, or does that aforementioned experience in front of your date to your dorms formal, where she sat in the very same lecture hall, take the cake there?
For background, I remember this was, I mean, spring 2010. This was this was intro to or like the intro to finance class that most that sophomore business students had to take. And so, there's several sections, each one with like several hundred people. And at the start of class one day, the teacher has sorry, the teacher has someone who's leading this charity drive on campus called St. Baldrick's come up and speak. St. Baldrick's involved donating money to shave your head, for the cause of just develop raising awareness and donating to the like cancer research. And I remember the person giving this talk, they brought a barber with them, and then they sat down in front of this whole class and got their head shaved in front of everyone. So that happens. The teacher stands up and says, "Okay, we've got time for one more haircut. Who wants it?" And I raise my hand, and he looks at me, calls on me, and in my mind, I'm like, "Oh, like, oh shit."
This is real.
This is real. So I go down. I remember going down to the front of the class, and like, I mean, you mentioned, you mentioned like we are our dorms formal, coming up like within the next few days. I was planning to get a haircut anyway. My hair was feeling shaggy at the time, not as shaggy as it is currently.
You have luscious locks.
Anyways,
for those who are not watching on video.
Yes, thank you. But no, it felt shaggy, and I was going to get a haircut anyway. I remember getting down to the front of the class, sit down and on the stool where I began this haircut, and the barber says to me, "I'm sorry, but all I have on me is a 0 and a 1 blade," which basically, yes. So I was going to get a much shorter haircut than I was planning on. I knew that. Well, I knew that. Okay, I wasn't crazy about getting my head shaved nearly all the way down. But I also know that I didn't want to be a coward. I didn't want to get up and go back to my seat, because that would just be such poor form. So yeah, I sat down. The teacher brought the mic to me and said, "So, like, what are you getting?" I'm like, I'm getting a buzz cut. And so and he's like, he starts teaching. He starts teaching. I'm just sitting there getting my head shaved in front of however many.
So the lecture was going on at the same time.
Yeah. The lecture had started. He's teaching. I'm just sitting there, just seeing locks of hair, seeing much more hair of mine than I expected, or than I had intended, falling down the floor. And I'm like, oh man, that's we'll see how this goes. But no, it ended. The teacher thought it was hilarious. He's a friend. He's been a reference for me. A couple times since then. He always ends up bringing that story up. So it's yeah, like it definitely ended up turning out well. But yeah, so it was it was a harrowing experience where I learned that maybe spontaneity is both a strength and a weakness for me.
I'm curious to switch gears a little bit. Um, when was the last time Peter's OS operating system went through a major update as opposed to a small hotfix? And what was in that update?
Remember this? I mean, this was almost 5 years ago now. This was fall 2019. I'm like I was in Europe. I was in Barcelona specifically, and I mean I remember leading into this time. I was going through something of a I, I don't know. I was going through this, maybe this investing crisis of conscience. Just wondering, I was struggling to find my own. I was struggling to find my own voice. I was struggling to be able to figure out what's truly the type of what's my own style for investing. And again, it was fall 2019, October 2019. I'm in Barcelona. I remember I remember seeing some of the sights of that city, and it was specifically while visiting the Casa Mila, this Antoni Gaudi, architected building there, and walking along the rooftop, looking out over the city, and realizing that, okay, that the architecture in Barcelona, I mean it's amazing, but Gaudi's works are literally extraordinary, out of this world, like far beyond the commonplace. He rushed past convention in the way that he designed and architected these structures, and it made me think about what does an artist like that, I mean, what's driving them, what's making them tick, what is yeah, what's causing them to create this art. And I remember in my mind realizing that, just it wasn't just creativity that built all this. It was conviction. It, it was love. It was it was feeling like just so determined to bring this art into the world, that that again, you risk rushing past the ordinary. You risk ridicule for making something different, but ultimately that's the only way to really leave a legacy. It's not to be in the consensus out of a misguided sense of self-preservation. It's really approaching your own life's work with creativity and conviction, and treating it like the art that it is. Yeah, those realizations, that train of thought. I mean, it really pushed me, well, across a lot of different aspects of life. It really changed me, and it helped lead me to the person I've become today.
It reminds me a lot of something Chris Duvos, I guess, also said on this podcast in an earlier season, where um he mentioned that you want to be like right and alone, and it's better, but like fortune and glory is all in the right and alone quadrant. So there's like right and wrong, and there's like alone and in the crowd. And the prerequisite to be right and alone means you have to be wrong and alone. You have to be willing to risk being wrong and alone, because if you're right and in the crowd, you've lost your ability to think independently, individually, and you've gone on to consensus. So it's about being like willing to take the risk of being wrong, and in the non-consensus. And it sounds like that was the lesson which you took when you were in Barcelona.
Some of that verbiage about, being in the consensus, avoiding it. Yes, yeah, it definitely comes from Duvos. He's given me he's given me that lecture as well, before. But but it's correct.
Hey, sometimes you don't
Like you,
internalize it until you actually experience it for yourself.
yes, yeah, like yeah, he's completely right.
Yeah, I agree. I completely agree. All right. Um, we are out of time, and I wish we had more time because, as you know, I sent you a million other questions in which to talk about, but in the sake of our busy schedules, I've got to let you go. But as a last question, before I let you go, Peter, you're everywhere. You're on LinkedIn, Twitter, the socials. You have your email and out there. What's the best way for people to find you in case they have questions on being an LP and how to think through things? Like, where do people find you?
You can reach me on all on all those channels that you mentioned. Yeah, like whether it's Twitter, email, LinkedIn, passenger pigeon. Probably not Facebook. I don't really. I can't remember the last time I updated my Facebook profile. I may not even have my login anymore. Like who knows? But yes, I mean feel free to reach out. It's not too hard.
Sounds like LinkedIn, Twitter, passenger pigeon is probably the way to go there. While you're at it, we need your mother's maiden name, your social security number. And yes, we'll leave that down. Leave those numbers in the show notes so people can find your bank account as well. Anyways, Peter, it's been such a pleasure. Thanks for being on here, and I can't wait for the next time we catch up.
Absolutely. Thanks again, David. This was great. The amount of preparation.
Hello, Superclusters fans. You've seen the logo at the beginning, and now we're here to address the elephant in the room. And the big question is, how intertwined is Superclusters and Alchemist Accelerator? And the truth is, Superclusters and Alchemist Accelerator are two completely separate entities, other than the fact that it is only I, David, your host, who is able to traverse between the multiverses. And so the reason Alchemist is a sponsor for Superclusters is the same reason why I ended up joining Alchemist. And it's for two reasons: the team and the product. So let me elaborate a little bit. For the team side, I was doing a bunch of diligence, homework, reference checks before I joined Alchemist, and I stumbled across a story which was between Ravi and an early team member of Alchemist. And for the sake of this story, I'm going to call that person John. So Ravi and John were working late at night because they had a deadline coming up, and as they were about to leave, Ravi found out that John didn't have a place to stay and had been sleeping out of his car the entire time. And the next thing Ravi did literally blew my mind, which was Ravi gave the keys to his place to John and said, "John, you're free to stay here for as long as you want." And I knew instantly that this is the team I wanted to join. This is the culture I wanted to be a part of. The second thing is the product itself. Alchemist has built this really robust product called the Vault, and it is the epitome of Peter Drucker's infamous line, which is, "You cannot manage what you don't measure." And so for the uninitiated, what is Alchemist Accelerator? Alchemist Accelerator is your startup accelerator for companies that monetize from enterprises. And so don't take it just from me. We've backed incredible companies, including names you've heard of: LaunchDarkly, Prevacera, MoEngage, and we're also backed by some incredible LPs and investors, including Khosla Ventures, Mayfield, Salesforce. And now, between you and I can't share any of the numbers, and if I do, our compliance officer, will literally gobble me up for breakfast, lunch, afternoon tea, and dinner. And personally, I'm too young to die. But I will say, the numbers, they're great. Like, they're really great. And so if you're curious and want to get involved in Alchemist and the ecosystem, check out alchemistaccelerator.com/superclusters. And that's superclusters with an S at the beginning and at the S at the end. And we'll also include these links in the notes. Hey Superclusters fans, this is David from Post and want to share a few things before you go. If you're tuning in from the YouTube universe, and if you like this episode and if you want to see more of it, consider subscribing. It's free. Let us know down in the comments which LPs you'd want to see next or topics you liked and want to hear more of. If you're tuning in from the audio universe on Spotify, Apple Podcasts, or wherever content finds your ear, and you liked what you heard, give us a follow. And lastly, want to share a quick disclaimer from our legal friends. While I am the head of investor relations at Alchemist Accelerator, and that Alchemist Accelerator is one of our proud sponsors, The views expressed in this episode are for informational purposes only and are solely the views of myself and the guest alone. They are not representative of Alchemist Accelerator. None of the views expressed herein constitute legal, investment, business, or tax advice, and any allusions or references to funds or companies are purely for illustrative purposes only and should not be relied upon as investment recommendations. Consult a professional investment advisor near you prior to making any investment decisions. And that's all from me. See you on the next.